Vanguard is by far one of my favorite brokerages out there. It is known for its commitment to low-cost index funds, which allow investors to achieve broad diversification at a low expense. In this video, we'll dive into my 10 best Vanguard index funds that I believe are worth considering for your investment portfolio. Number 1 on the list is VTSAX, the Vanguard Total Stock Market Index Fund. Its ETF equivalent would be VTI, the Vanguard Total Stock Market ETF. The fund has an expense ratio of 0.04% and a minimum investment requirement of just $3,000. Over the past decade, it has delivered an average annual return of 11.4%. If you had invested $10,000 10 years ago, it would have grown to $29,500. With a staggering $1.4 trillion in assets under management, it is the market's most popular and largest index fund. The fund aims to track the CRSP U.S. Total Market Index, which includes nearly every publicly traded company in the U.S., approximately 3,800 at the time. This broad coverage ensures a diverse and well-rounded investment. One of the key features of this fund is its self-cleansing mechanism. It automatically replaces underperforming companies with new and promising ones, ensuring that your investment remains focused on growth and potential. Number 2 on the list is VFIAX, the Vanguard 500 Index Fund. Its ETF equivalent is VOO, the Vanguard S&P 500 ETF. The fund has an expense ratio of 0.04% and a minimum investment requirement of $3,000. Over the past 10 years, it had an average annual return of 12%, meaning a $10,000 investment 10 years ago would have grown to $31,000 today. The Vanguard 500 Index Fund mirrors the S&P 500 Index, offering exposure to 500 of the largest companies in the U.S. The S&P 500 has long been considered the most widely used representation of the stock market. When people talk about the stock market in the news, they often refer to the S&P 500, not the total market index. Companies in this fund are not equally represented but are represented by their market capitalization value. The bigger the company, the bigger the representation. If you like the idea of holding the largest companies primarily in your portfolio, this fund is a great choice as your core equities holding. Number 3 on the list is VTWAX, the Vanguard Total World Stock Index Fund. Its ETF equivalent would be VT, the Vanguard Total World Stock ETF. The fund has an expense ratio of 0.1% and a minimum investment requirement of $3,000. Although the fund is relatively new, we don't have exact data going back 10 years, but it would have had an average annual return of around 10% if it had existed. If you had invested $10,000 10 years ago, it would have grown to approximately $26,000 today. This fund represents nearly 9,700 stocks worldwide, including both U.S. developed and foreign markets as well as emerging markets. It holds large U.S. companies like Apple, Microsoft, and Amazon, as well as big international companies like Taiwan Semiconductor Manufacturing, ASML Holdings, and Samsung Electronics. The fund's allocation is approximately 60% U.S. and 40% international. Essentially, it's a one-stop fund that represents the global stock market. This fund will be ideal if you want exposure to both the U.S. and international equities markets but don't want to hold separate funds for each. Number 4 on the list is VTIAX, the Vanguard Total International Stock Index Fund. Its ETF equivalent would be VXUS, the Vanguard Total International Stock ETF. The fund has an expense ratio of 0.11% and a minimum investment requirement of $3,000. Over the past 10 years, the fund has delivered an average annual return of 4.1%, meaning a $10,000 investment 10 years ago would have grown to nearly $14,900 today. With assets under management close to $400 billion, it is the market's most popular international index fund. The fund aims to track the FTSE Global All-Cap ex-US Index. At the time of this video, the index represents approximately 8,500 national companies from both developed and emerging markets. Investing in this fund diversifies your portfolio by including international companies and potentially benefiting from growth opportunities that U.S.-based companies may not provide. While U.S. stocks have historically offered great returns, they still only represent about half of the world's total stock market value, which is approximately $110 trillion. U.S. companies account for $46 trillion of that, or about 42%. Although the past 10 years have not been the best for the international market, there have been times in history when international companies outperformed U.S. companies. Number 5 on the list is VSMAX, the Vanguard Small Cap Index Fund. Its ETF equivalent would be VB, the Vanguard Small Cap ETF. The fund has an expense ratio of 0.05% and a minimum investment requirement of $3,000. It represents approximately 1,400 small-cap companies. In the past 10 years, it had an average annual return of 8.4%. This means if you had put $10,000 10 years ago, it would have grown to around $22,500 today. Small-cap stocks tend to outperform large-cap during periods of economic expansion. However, it's worth noting that small-cap stocks can be more volatile than their large-cap counterparts. A big company might not have the aggressive growth trajectory of a small up-and-coming startup, and investors often look to mid-cap stocks as being more stable, while small-cap provides stronger growth opportunities than large-cap companies. Nonetheless, if you believe that small-cap companies have the potential to provide greater returns in the future, this fund will serve that purpose and could be a nice addition to your portfolio. Number 6 on the list is VIMAX, the Vanguard Midcap Index Fund. Its ETF equivalent would be VO, the Vanguard Midcap ETF. The fund has an expense ratio of 0.05% and a minimum investment requirement of $3,000. This fund holds around 340 companies. It had an average annual return of 9.4% in the past 10 years. This means if you had put in $10,000 10 years ago, it would have grown to over $24,500 today. The reason to add it to your portfolio will be identical to adding a small-cap fund. Historically, there have been times when small-cap and mid-cap companies have performed a bit better than large-cap companies. And though thousands of small and mid-cap companies are already represented in a total market index fund, they hold a minor position due to market capitalization. Number 7 on the list is VIGAX, the Vanguard Growth Index Fund. Its ETF equivalent would be VUG, the Vanguard Growth ETF. The fund has an expense ratio of 0.05% and a minimum investment requirement of $3,000. This fund comprises large-cap growth stocks of U.S. companies such as Apple, Microsoft, and Google. It invests in a diversified mix of stocks that are expected to have strong growth potential. This fund holds around 220 companies. It had an impressive average annual return of just under 14% in the past 10 years. This means if you had put in $10,000 10 years ago, it would have grown to $37,000 today. Investing in this index provides exposure to a broad range of large-cap growth companies, which can help to diversify your portfolio. Overall, this fund offers a low-cost way to invest in a diversified portfolio of large-cap growth companies with a history of strong performance, making it an attractive option for investors seeking long-term growth. Number 8 on the list is VGSLX, the Vanguard Real Estate Index Fund. Its ETF equivalent is VNQ, the Vanguard Real Estate ETF. The fund has an expense ratio of 0.12% and a minimum investment requirement of $3,000. In the past 10 years, VGSLX had an average annual return of 7.4%. This means if you had put $10,000 10 years ago, it would have grown to $20,300. The fund is a REIT that owns, operates, and finances income-generating real estate. They're essentially a mutual fund that holds real estate, just as mutual funds allow us to buy publicly traded companies without buying individual stocks. REITs allow us to tap into the real estate market without actually buying, managing, and financing any properties ourselves. VGSLX represents approximately 160 publicly traded companies representing all types of property, investments, office buildings, hotels, and even residential homes. This fund could be a good addition if you want to add some real estate flavor to your investment. There have been times in history when REITs have performed better than stocks. Number 9 on the list is VBIAX, the Vanguard Balanced Index Fund. At the moment, this fund doesn't have an ETF equivalent but offers an expense ratio of 0.07% and a minimum investment requirement of $3,000. In the past 10 years, the fund had an average annual return of 7.7%. This means if you had put $10,000 10 years ago, it would have grown to $21,000. The fund holds around 3,300 companies, including Apple, Microsoft, and Amazon, and is offering a yield of 2.5%. The fund's primary objective is to provide long-term capital appreciation and income by investing in a diversified mix of stocks and bonds, currently set at around 60% stocks and 40% bonds, making it a popular investment option for those seeking simplicity and a balanced approach to investing. Number 10 on the list is VBTLX, the Vanguard Total Bond Market Index Fund. Its ETF equivalent would be BND, the Vanguard Total Bond Market ETF. The fund has an expense ratio of just 0.05% and a minimum investment requirement of $3,000. It's the market's most popular bond index fund with an impressive $300 billion in assets under management. At the moment, it represents approximately 10,700 individual bonds and currently offers a dividend yield of 4.3%. They provide stability to counteract the volatility of stocks, which can be quite erratic due to news and market fluctuations. Bonds may not have the same long-term returns as stocks, but they offer a much smoother investment experience without the volatility of stocks. In times of market crashes, when your stock investments might dip by 20 to 30%, your bond investments will hold your portfolio steady. This fund is a top choice for investors seeking to balance their portfolios and mitigate risk. Vanguard index funds offer a low-cost, diversified, and reliable way to invest in the stock market. With various options available, investors can choose the fund that best aligns with their financial goals and risk tolerance. If you found this video helpful, make sure to like and subscribe for more content on personal finance and investing.